This LOS is calculate and interpret the leverage ratio, the rate of return on a margin transaction, and the security price at which the investor would receive a margin call. Leverage positions. Now we're going to look at when we're buying stock, but we're using some borrowed money. Okay, so when we talk about trading on margin, it's when we borrow part of the money needed to buy the stock. And the initial margin requirement is the minimum fraction of the purchase price that must be the trader's equity. So to be clear, when we're talking about the initial margin, that's the initial E, the trader's equity, not the amount that you're borrowing, the amount that you have to put in, okay? So a lot of times I like to look at these questions just going back to assets equals liabilities plus equity. The asset is the stock that you're buying, the equity is the money that you're putting in, and the liability is the money that you're borrowing, okay? So when we look at calculating the returns on the trade, we're looking at the return on equity for all intents and purposes, okay? So brokers hold the stock asset as collateral, and the margin requirement, the required equity percentage in the United States, is set by the Federal Reserve Board, and it's currently 50%, okay? And the maintenance margin is the minimum equity position, and the equity percentage is the stock value minus the loan divided by the stock value. So we're going to work through this return on margin position example, and I know there's a lot on the slide going against the PowerPoint guidelines of like 6 main bullet points, but it's just that I want to have the question here and the calculations all on one spot so it's easy to work through, okay? Not flipping back and forth from slide to slide. So let's just go through this example. A buyer buys stock on margin and holds the position for exactly 1 year. We need to know the timeline because there's interest when you borrow money. During which time the stock also pays a dividend, which is income to you. For simplicity, assume that the interest on the loan and the dividend are both paid at the end of the year, so there's no timing calculations that you need to make. So the purchase price of the stock is $20 per share, and the sale price is $25, so we know that we made some profit. The shares purchased is 1,000. The leverage ratio, this is something that we're going to see now when we're talking about margin positions. There's a leverage ratio of 2.5. We're going to see more about how we calculate that and what it means. The call money rate is 5%. We're borrowing money. That's what we have to pay. And the dividends is 10 cents per share. We bought 1,000 shares, 10 cents per share, so we know what the dividend is going to be. And there's also a commission of 1 cent per share, and there's commission when we're buying and selling, okay? So you can see our initial investment is going to be $8,010, and that is that's not the value of the A, that's the value of our E, okay? And I'm going to show you how we're going to run through that. So assets equals liabilities plus equity. The asset is the stock value plus the commission, okay? So it's $20 times 1,000, 20,000, and our commission is 1,000 shares times the 1 cent per share, which is $10. So our initial asset is $20,010, okay? So now you can see this leverage ratio, the leverage ratio. Our liability is going to be 20,000 minus 20,000 times 1 divided by 2.5. So when they give you the leverage ratio of 2.5, our equity that we need to put in is 1 divided by 2.5, okay? So we'll just bring the calculator up so you can see when they give you a leverage ratio of 2.5, then we do 1 divided by 2.5, and that's the initial margin requirement. You can see it's 40%, okay? So in these types of questions, they can give you the initial requirement in terms of a percentage, like 40%, or they can give you a leverage ratio 2.5, okay? What is 100 divided by 40%? And that's going to equal 2.5, okay? So just when the leverage ratio is 2.5, it means my initial margin requirement is 40%, okay? So you can see, just bring the calculator up again, if I do 20,000 times 0.4, you know that I'm going to have to put in initial margin of $8,000, but then don't forget about the commission as well, the $10. So the way that we work that out in terms of the assets equals liabilities plus equity, our asset is 20,010. We're going to borrow $12,000, and our initial margin, our initial equity is 8,010. So I put there in bold. Just remember here to add the commission to the asset and the equity, and the leverage ratio is applied to the equity. Okay. So now we're going to go through our profit and loss. In this case, it's a profit because we bought at 20, we sold at 25, okay? So we can see our trading gains was $5 per share times 1,000 shares, which is $5,000. That's the 25 we sold for minus the 20 that we bought equals $5 a share times 1,000 shares. And that's going to be $5,000 on the sale of the stock, okay? But don't forget, we have to pay some margin interest. So we borrowed $12,000 and we had to pay 5%. So 12,000 times 5%, barely need the calculator for that. That's a negative of 600. Also, we received the dividends. Recall that we had dividends 10 cents per share and we had 1,000 shares. So we received $100 of dividends. So that's a positive into us. And then when we sold the stocks, we also had to pay the commission again. 1 cent per share times 1,000 shares is a negative 10, okay? So you can see then we're just looking at our value of our equity. We had initial equity, 8,010, plus the 5,000 that we gained on the trade, minus the 600 that we paid on the interest, plus 100 on the dividend, minus the 10 on the commission, means our equity is 13,700. So again, as I said, assets equals liabilities plus equity. We can do an ending, ROE, return on equity. What was our return on the trade? Well, it's our ending divided by the beginning minus 1 times 100. So just bring up the calculator here very quickly. We have ending equity of 13,700, and we're going to divide by our initial 8,010, and we're going to minus 1, and then we're going to multiply by 100, and you can see that that worked out very well for us. We had a 71% return on our equity on that because we were leveraged. This is the whole key. So you see the difference is in the investment return. If I would have paid all cash just very quickly, not including all the commissions and dividends, etc., but the ending price divided by the beginning, 25 divided by 20 minus 1 times 100 is 25%. So by using leverage, by borrowing money on margin, the return to our equity is amplified. And that's the power of leverage, although I said, however, it's a double-edged sword, of course. And the text just pointing out they were using a selling price of $15 per share. And the ROE was negative 68 because they bought at 20 and they sold at 15. I just changed it so that we bought at 20 and we sold at 25, okay? So that's a nice little example. I like to put these as assets equals liabilities plus equity. Again, equity is our initial margin. They're going to give us either a percentage like 40%. If we do 1 divided by 0.4, that's going to give us our leverage ratio, 2.5. And we have to understand how we incorporate, we receive dividends, which adds to our equity. We pay interest, which decreases our equity. And we pay commissions, which decreases our equity. So to calculate our return on equity, we look at our initial equity, and then we add our gain or loss on the sale, subtract the interest, add the dividends, subtract the commission. That's our ending equity, okay? And then return on equity is the ending equity divided by the beginning minus 1 times 100. We get our ROE. So again, on this slide, we're looking at the leverage and minimum margin requirement. So we saw that in the previous slide, the leverage ratio is 2.5. And I just wanted to show how do we get that? It's 1 divided by the minimum margin requirement. So if they give you the margin requirement as 40%, then 1 divided by 0.4, as I showed you before, 1 divided by 0.4, our leverage ratio is 2.5, okay? So that's something you need to know. And that last question gave us the leverage ratio. What was the minimum initial margin requirement? Then what we do is we do the 2.5 equals 1 divided by the minimum margin requirement. So the minimum margin requirement is 1 divided by 2.5, which equals the 40%. It's just simple algebra, okay? So again, from the previous question, it was 20,000 times the 40%. So we had an initial margin requirement of $8,000. So down here it's saying, ignoring transaction costs, dividends, and interest, a price return of 25% on the stock resulted in a leverage return, 2.5 times 25%, equals 62.5% on invested cash. So the example had the dividends, etc. So sometimes I just like to do a quick, if you're doing a leverage position and you're looking at, sometimes you can see there's quite a few little calculations to do on that, but sometimes you're given a multiple choice question with A, B, and C, and some of them aren't reasonable at all. And if you just do the quick check of the the leverage ratio times the price return, you'll see that maybe only one answer could possibly be right. So sometimes that's a shortcut, you know, and that's why one of the reality checks that I do is just to look at that leverage ratio times the price return, and then I know I'm going to be plus or minus in that ballpark because of interest, dividends, and commissions. Initial margin, maintenance margin, and margin call. So if the value of the equity falls below the maintenance margin requirement, the investor must add cash or marginable securities, or you must close the position. That's called a margin call, okay? And that's the risk of borrowing on trading on borrowed money, that if you get a margin call and you can't put in more cash and you can't put in more marginable securities, then closing the position means you're going to be sold and you're going to get a loss, okay? You're going to be closed out. So that's the risk of trading on margin. So again, let's just look. The initial margin is 40%. The maintenance margin is always going to be a lower amount. In this case, we're looking at an example of 25%, okay? So let's just go through this. The purchase price is $20. The maintenance margin is 25%. The leverage equals 2.5. So we saw how we calculate the initial margin. It's 40%, which is 1 divided by the 2.5. So this is a formula that you absolutely must have to memorize and recall. It's the price at what you receive a margin call, okay? So the way that we calculate it is our initial price times 1 minus the initial margin over 1 minus the maintenance margin, okay? So I always remember that as IM over MM. But of course, just remember, the maintenance margin is going to be lower. So if you had your numerator and denominator reversed, you would have a number that's greater than 1, and your price would be higher. Then obviously you're not going to get a margin call when your price has gone up. So I think this one is fairly easy to understand about getting your numerator and your denominator. It's just 1 minus IM in the numerator, 1 minus MM in the denominator, okay? So as we said, if they give you the leverage ratio, though, you need to know what that percentage is, and that's easy. It's just 1 divided by the leverage multiplier, okay? So in this case, if we bring up the calculator, and I can do the math in my head, 1 minus 0.4 is going to be 0.6, and it's going to be divided by 0.75, okay? And I'm just going to multiply that by our initial price of $20, and I'm going to get $16, okay? So these type of questions, when they're asking at what price would I receive a margin call, is really fairly easy. It's the price times 1 minus the initial divided by 1 minus the maintenance, and the numerator is going to have the larger number than the denominator, okay? So fairly easy. When you buy securities on margin, you must know the price at which you will receive a margin call if the price drops. The answer to this question depends on your initial equity and on the maintenance margin requirement. Okay, maintenance margin example. There's a second method in the text. I just want to point this out so that we're consistent that we followed what's in the textbook. But as I said, this formula, just skip to the bottom, price times 1 minus initial divided by 1 minus the maintenance is a lot easier. I wrote that. But this is the example that they go through in terms of the text. The margin call is the loan amount per share divided by 1 minus the maintenance margin, okay? And so just going back to that same example, the purchase price was $20. So our minimum margin requirement was the 20 times the 40%, which is $8 per share. So it means that assets equals liabilities plus equity, we were borrowing $12 per share. So the margin call, the $12 divided by 1 minus the maintenance is 25%. So it's 12 divided by 0.75. We're going to get $16, okay? So that's the way they do it in the text. But as I said, my advice is always pick one method. It's two methods giving you the same answer. Pick one method and stick to what you know and what you like best. But I just want to point it out. For me, personally, the way that I like to remember how to calculate the margin call was the initial price times 1 minus the initial over 1 minus the maintenance, because I told you that, it's easy to calculate those percentages and it's easy to get the numerator and the denominator correct, okay? So just a quick thing there on a little bit of, again, as per the CFA, 2 different ways to calculate the same number. Choose one method that you like the best and stick with it. So margin call, just a quick little practice here, not a multiple choice question, just let's review the calculation. So an investor buys a stock on margin at a price of $80. The initial margin requirement is 40% and the maintenance margin is 25%. at what stock price will the investor receive a margin call? Okay, you'll see that this is fairly easy. Again, I like to use the formula that the margin call is the initial price times 1 minus the initial margin divided by 1 minus the maintenance margin. So it's going to be the $80 times 1 minus 0.4 divided by 1 minus 0.25. Okay, so as I said, I can bring up the calculator. I can pretty much do it in my head. 0.6, divided by 0.75, and I'm going to have 0.8, and then I multiply that by the $80. And you can see if I get a question like that, $64 is the price that I'm going to receive the margin call. That's a lot quicker than a 90-second question. You know the formula, you're confident. You have no doubt you got the right answer. You're very happy to see a calculation question like that on the exam. Okay, we're going to do another practice question here. An investor opens a margin account with an initial deposit of $5,000. He then purchases 300 shares of stock at $30. His margin account has a maintenance margin requirement of 30%. Ignoring commissions and interest, the price in dollars at which the investor receives a margin call is closest to A, $19.05, B, $23.08, or C, $23.81. Okay, this is a nice little question because they just put a little twist to it. They said that the investor opened a margin account with initial deposit of $5,000. That's his equity, his or her equity, okay, their initial deposit. And then it says they bought 300 shares at $30. So that's our asset. 300 shares times $30 equals $9,000. And our equity is $5,000, okay? So how much are we going to borrow? We're going to borrow $4,000. We don't really need that for this question, but nevertheless, I just wanted to show you that to calculate at what price you're going to receive the margin call, you need to do 1 minus the initial margin. They're not telling you the initial margin in terms of a percentage. They're giving you the initial equity, and they're giving you the initial asset, okay? So equity divided by the asset is your initial margin, okay? So the 5,000 divided by the 9,000, that gives you initial margin of 0.5556. So that was the little trick here. And so then we just... we get into our doing our calculation for the price at which we'll receive the margin call. It's going to be price times 1 minus the initial margin divided by 1 minus the maintenance margin. And so let's just bring up the calculator very quickly. So in this case, I can't do it in my head because it's kind of a number that's not rounding so nicely. So I do 1 minus 0.5556. I'm using 4 decimals here. It's going to be close enough anyhow. Divided by, I can do that one in my head, 0.7, okay? And I'm going to multiply by my initial $30 stock price, and you're going to see that I'm going to receive a margin call at closest to A, $19.05. So in this case, the correct answer is A. So again, the little trick here is that they gave us our initial deposit, that's our E. They gave us the initial value of the stock that we're buying, 9,000. So E over A, that's our initial margin in terms of a percentage. We use that then to calculate the margin call. So a very typical CFA 101 type calculation where you need to know the formula, but before you can do the formula, you have to do a little sub-calculation. Excellent little question. Another little practice problem. A trader who buys a stock priced at $64 on margin with a leverage ratio of 2.5 and a maintenance margin of 30% will most likely receive a margin call when the stock price is at or falls just below A, $36.57, B, $44.80, or C, $54.86. Okay, by now I hope you're finding these questions to be fairly easy. So it's asking, what price we would most likely receive a margin call. So we have to remember the formula. Margin call equals the initial price times 1 minus the initial margin divided by 1 minus the maintenance margin. So they're giving us the maintenance margin 30%. But you can see they're not giving us the initial margin in terms of percentage. They're giving us the leverage ratio. So we know the initial margin equals just 1 divided by the leverage ratio equals 1 divided by 2.5. Just bring up the calculator. We've seen this example already though. That's using the same numbers, 1 divided by 2.5, and that's going to equal our 40%, okay? So that equals our 40%. So now we can simply plug the numbers into the calculator. It's going to be 64 times 1 minus 0.4 divided by 1 minus 0.3, our maintenance margin. So we can see it's going to be $64 times 0.6 divided by 0.7. And again, that number's got to be less than 1. The stock, you're not going to get a margin call at a stock higher than your initial price, okay? So you know, that's why I said these questions are fairly easy to do and fairly easy to memorize the formula. So I'm just going to bring up the calculator then. It'd be 0.6 divided by 0.7 and times by 64, and I'm going to be 54.85714, and that is indeed closest to C. So C would be the correct answer, okay? So again, this is a question very typical of what you could see on the exam. If you see something like this on the exam, you're very happy because you knew the formula, you knew how to calculate it. There's no doubt, it's only C could be right, and you move on, okay? So nice little quick practice question. Okay, we're going to do another practice question, but this is not the price that we receive a margin call. It's now calculating your return, okay? So an investor borrows the maximum amount allowed by the initial margin requirement of 40% to purchase 100 shares of stock, selling at $60 per share. If the investor sells the stock when the price increases to $70 per share, her return in terms of percentage before commissions and interest will be closest to A, 16.7%, B, 27.8%, or C, 41.7%. Okay, a couple ways to tackle this problem, but I put here again my recommended way. Assets equals liabilities plus equity. So we bought 100 shares at $60 per share. That's 6,000, and our initial requirement was 40%. So we always have to remember that initial margin is our E. So what we do 6,000 times 0.4, and we know that our initial E is 2,400. So we would have borrowed 3,600. So then the stock price has gone up to $70 per share. So assets equals liabilities plus equity. Well, our liability hasn't changed because we're ignoring interest and commissions. So 7,000 would equal 3,600 plus X. We'd solve for X. We can see that our E has gone up by 1,000. So then ending E divided by beginning E minus 1, we're going to equal 41.667%, okay? Another quick way to solve this is that they're giving us our margin requirement at 40%, okay? So what is our leverage ratio? Our leverage ratio equals 1 divided by 0.4, our initial margin. And we know we've seen this now many times, 2.5, okay? So I know that our return on is going to be amplified by 2.5%. So if I bring up my calculator again, and I did 70 ending price divided by my 60 beginning price, okay, minus 1, and times 100 if I want to make a nice round number, we're going to get 16. That was the return on the price alone. But if I multiply that by my leverage ratio, 2.5, then I've also got 41.667. So there's no doubt that C is correct. Okay, now I put here, this is kind of the solution as per the text that I've seen. I'm not even going to get into it. It goes through a market value of the stock minus the loan over the investor's equity, etc. Again, it's just a different way to approach the problem to solve it, but I like to stick to things the easy way. And as I said, for these problems, I like to look at assets equals liabilities plus equity, and it's asking for my return. That's my ROE. It's my return on my equity. And if you approach it this way, I think it's very easy to understand the question. Or if I look at the price return and multiply it by the leverage ratio, that's also an easy way to understand the question. So that last question was very easy because it was calculating the ROE and it wasn't including any interest or dividends. So a question like that is quicker than 90 seconds. Now you can see here's a new question. So it's testing the same LOS, but they're giving us more data and there's a few more calculations that we need to do. And that's why on the CFA, you're always going to see a range of questions that go from fairly easy to fairly harder, even if it's testing the same LOS, okay? So in this case, an investor buys a stock on margin. Assume that the interest on the loan and the dividend are paid at the end of the year. That's what we've seen. And so here's the data. There's 500 shares being bought. The purchase price per share is $28. Aha, the leverage ratio 3.33. So now we're not seeing 2.5. The commission is 5 cents per share. The position holding period is 6 months. Aha. Sale price per share is $30. And the call money rate is 5% per year. So we're going to have to adjust our interest, right? So you see the little trick there. They've given us position holding period of 6 months. And that's fairly typical of the CFA, a little bit of twist or turn here and there. And we're receiving a dividend of 40 cents per share, okay? Not 4 cents, 40. You got to be careful. So the investor's total return on this investment over the margin holding period is closest to A, 15.6%, B, 16.7%, or C, 21.9%. Okay, I like this question because to solve it properly, we got to go through a lot of calculations, okay? And in 90 seconds, that's going to take a little bit of time. And as I said, you don't want to be guessing, but in this case, you can do a pretty educated guess, and I think you're going to have the right number. Now, I don't recommend this, I always recommend you to do the calculation 100%, but I just want to show you sometimes if timing is an issue, you want to do what I call the reality check first, okay? So let's just bring up the calculator and see, we're looking here to calculate the return on equity, okay? So we can see we sold the stock for $30. So $30 divided by our $28, okay? And we're going to minus 1 if we want, and then even multiply it by 100 to get a nice round number. And if we multiply that by our leverage ratio, the 3.33, you're going to see that our return on equity, because it's leveraged, is going to be in and around 23.78%, okay? Now the 23.8%, we know that we've got some interest and we've got some commissions, but we also have some dividends, but we're going to be close. So you can see none of these questions, none of the other answers were anywhere close to the 23%, except for C. C was 21.9%. And indeed, that is the correct exact answer. But we see to calculate that the long way, we're going to have to go through quite a few calculations. First of all, we have to get our initial investment, and also we have to calculate the interest that we paid. So this all takes time. Whereas I said, if you just do your quick reality check, looking at the price return times the leverage ratio, one answer may only be the only one that's really close in the ballpark. In this case, it is. And I might have, if I was pressed for time, I might have answered C and moved on, and I would have been right in that case. Nevertheless, let's go through the question 100% to calculate it the right way. And so we have our initial investment. Remember, it's the $28 times the 500 times by our initial margin requirement. Now here they've given us the leverage ratio. So recall our initial margin requirement is 1 divided by the leverage ratio. So it's 1 divided, and they're giving us a funny number, 3.33. So it's not rounding perfectly. You see, they're giving us 30% plus a little bit. Okay, so that would be times by the $28 and times by the 500 shares that we're buying. And so our initial margin would be 4,204, but we're not done yet because we have to add the commission, 5 cents times the 500 shares. So we have initial margin, our initial equity of 4,229, okay? The trading gain is easy to understand. It's $30 minus 28, $2 per share times 500 shares equals 1,000. But here we had to have our initial, our interest paid, okay? So our initial equity was 4,200. So if I just bring up the calculator again very quickly, we're going to see that, okay, I did 500 shares times by 28. So my initial asset was 14,000, okay, plus the commission, 14,000. And I'm going to, my initial margin was 4,200. So just getting a ballpark figure, minus 4,200. That means I borrowed $9,800, okay? I borrowed $9,800. And in this case, I can times by 5%, but it's only for a half a year, so I need to divide by 2 or multiply by 2.5%, and I get 245, okay? So that's my interest that I had to pay. Then I'm going to receive some dividends. 40 cents times 500 is 200. And I'm going to have to pay some commissions, minus 25. So again, we just go through my initial E plus the trading gain, minus the margin interest, plus the dividends, minus the commission on the way out, gives me my ending E. So this is my E ending, this is my E beginning, and I do ending minus beginning divided by beginning, and I get 21.99%. Okay, just bring up the calculator again here just to see that quickly. I can do my ending 5159 divided by 4229. Whoops, made a little mistake there on my keystrokes. 5159 divided by 4229. and we've got 21.99%. Okay, just do -1 times 100 if I want to see the round number, 21.99. So again, I've spent quite a bit of time on that solution, but if I did the just the quick reality check of 30 divided by 28 -1 times 100 times 3.33, really one answer was really closest to the correct answer in that case. But a lot of times it's not going to be such the case. You'll have 21.9%, you'll have 22.4%, and 20.88%. They'll all be so grouped so closely that you can't use the quick reality check. You've got to actually crank through the whole calculation, but that's just a bit of an exam tip. And one last practice question to finish this LOS, and it's the same type. It's just another quick practice. We won't spend as much time on the solution. I just want to throw this in as extra practice. So you can see stock purchase price $50 per share, sale price $55, shares purchased 500, margin is 45%. So in this case, they gave us the percentage, not the leverage ratio. Call money rate 6%. Dividends $1.80 per share, transaction commission on purchase 5 cents per share, transaction commission on sale 5 cents per share. If the stock is sold exactly 1 year after the purchase, total return on the investor's investment is 14%, 19%, or 22%, closest to. So in this case, they're giving us two answers that are fairly close together, B and C. Now it's 19 and 22%. But let's see if our reality check, how that works out. So we know that we sold at $55, and we're going to divide by our $50, okay, minus 1, and times 100. So we're going to have a price return of 10%, okay? So we have a price return of 10%, and we're going to multiply it by our leverage ratio. Aha, they didn't give us the leverage ratio, they gave us a margin percentage, but we can bring up the calculator, and we know to get the leverage, it's just 1 divided by 0.45. So our leverage ratio is 2.22. If I multiply that by our 10% price return, I'm at 22.22%. So, C was correct. We're going to end up at 22.616 when we add the dividend minus the margin interest. We're pretty close. Again, if I was really pressed for time, I may not take the time to crank my whole way through the calculation. Now, I'm not recommending that, but I'm just saying in some cases, you've got to take some shortcuts, do your best efforts. And in this case, your shortcut is going to work. Okay. So let's just crank through the solution the same way. It's just laid out in the exact same format. It was just meant to be another last practice. You got to have your initial equity, which is our $50 times the $500 times 45%. They gave us the percentage, which is nice. Don't forget to add the commission, $11,275. Add the training gain is easy, $5 a share times 500 shares, $2,500. But again, you had to calculate the margin interest. So that would have been, you can see I'm borrowing 55% because I'm being loaned 45%. So it's $50 times 500 times 0.55 times my 6%. It's for the whole year. So that calculation was fairly easy, and that's a negative. Add the dividends, $1.80 share plus times 500 shares, 900 is easy. And the sales commission is easy, 5 cents times the 500. So again, we just go through initial margin, add the trading gain, subtract the interest, add the dividends, subtract the sales commission. We get our ending equity divided by the beginning. Just bring up the calculator very quickly here. I had ending 13,825. Going to divide by my beginning 11,275 minus 1 and multiply by 100, so I get a nice round number. And I'm going to have 22.61, and taking my shortcut, guesstimation was 22%. This is 22.61. Okay, so correct answer C. That's the last slide for this LOS. It's been a long one, but there's been a few calculations here. These should be easy calculations. You see questions like this on the test, you're actually pretty happy about it. So last slide for this LOS. Thank you.